Hey guys, today we're going to talk about what you need in order to be able to purchase your first home. First, we'll discuss the elements you typically need in order to purchase property. Then we can discuss the benefits first home buyers are afforded in order to make their journey easier. Now, in order to buy a property, assuming that you will be utilizing a loan to fund the purchase, you need two elements to be in order. The first is your deposit. The second is your serviceability. Now, typically, a bank will want at least a 20% deposit in order to be willing to give you the loan without charging LMI. Now, LMI is an acronym which stands for Lender's Mortgage Insurance. This is a premium which is charged to you in the form of a lump sum which is added to your loan balance and which you repay over the life of the loan. It's charged if you have less than a 20% deposit, and the lower your deposit, the more expensive the LMI can be. It can be extremely expensive, ranging in tens of thousands of dollars. Another thing to be conscious of is it does not protect you. It protects the bank in the event that you default on your loan and they are unable to claim their capital back. In addition to the 20% deposit, you need to be able to cover your stamp duty costs. Now, this varies from state to state, and there's a degree of variability depending on the actual value of the property. Typically, it tiers up for more expensive properties, but as a rule of thumb, you can approximate it to be approximately 4 to 5% of the purchase price of your property. Adding these two together, you need 20% for the deposit and 5% for the stamp duty, for a total of 25%. If you have these, then you have sufficient cash in order to purchase your property. The second requirement is that you are able to pass the bank's serviceability criteria. Now, serviceability is a measure of your income relative to the cost of a loan. A general rule of thumb is that your borrowing capacity will be approximately 5 times your income. Now, be clear, this will vary from person to person, from family to family, depending on spare cash flow, expenses, number of dependents, but as a general rule of thumb, it works quite well. Once you have both of these elements in order, you're able to access the finance needed to purchase a home. Now, circling back, we should talk about the benefits for first home buyers. In order to assist first home buyers, the government has implemented 4 schemes to help them overcome some of the hurdles associated with purchasing a home. The benefits for first home buyers are 1. The First Home Owner Grant, 2. The First Home Buyer Stamp Duty Exemption, 3. The First Home Super Saver Scheme, and 4. The First Home Guarantee Scheme. Now, each of these benefits has different rules, but 3 of them are actually state-based, or at least have some degree of variability between the states. The only one which is nationally homogeneous is the First Home Guarantee Scheme. If we look at the first scheme, or the first grant, it's the First Home Owner's Grant. In New South Wales, this is a grant of $10,000 given to first home buyers who buy a new or substantially improved property. The property must be valued at less than $650,000, or if it's a house and land build, $750,000. The First Home Buyer Stamp Duty Exemption provides first home buyers with a full stamp duty exemption up to a purchase price of $800,000 and a prorated stamp duty relief between $800,000 and $1 million. This means that if you bought something at $800,000, no stamp duty whatsoever would be payable, whilst a purchase of $900,000 would benefit from a 50% discount on stamp duty, as it's halfway between $800,000 and $1 million, where that pro-ratering is applied. The general eligibility criteria for both benefits is approximately the same. The first criteria is you must be over the age of 18. Secondly, you must be a citizen, or if not a citizen, a permanent resident. The third requirement, you or your spouse must not have previously owned a home or property. The fourth requirement is you must occupy the property within 12 months of its purchase. That occupation period can be no less than 12 months. The First Home Guarantee Scheme is a scheme where the government, rather than requiring you to put a 20% deposit down on the purchase of your first home in order to avoid LMI, jumps in and in effect provides that guarantee to the bank. This allows you to put forward as little as 5% towards the deposit for the scheme. Now, in order to apply for the scheme, first home buyers must fulfill the following criteria. They must be an individual, they must be an Australian citizen, or, failing that, at least a permanent resident. They must be at least 18 years old. There are also income requirements. For an individual, they can earn no more than $125,000 per annum, or for a joint application, household income of less than $200,000. The intention must be for them to be the occupiers of the purchased property, and there are property value limits which apply to different states based on the scheme, as well as different capital cities versus different regional areas. The final benefit is the First Home Super Saver Scheme. This scheme allows you to have your superannuation and contribute it in order to save for your deposit rather than just contributing into a cash account. The way that it works is that you can contribute $15,000 per annum to your superannuation as voluntary contributions each year, and then take out a total of $50,000 across multiple years plus associated earnings. In effect, this allows you to direct concessional contributions towards your superannuation and benefit from a tax rate of 15% rather than your marginal tax rate, whatever it might be, 32%, 39%, or 47%. In effect, this provides you with a 15% tax advantage on utilizing this scheme because you've got a 15% tax on the money going in, but a 30% tax offset when the money comes out. It's important that you follow the correct processes with the FHSS, as otherwise you could face excess taxation when utilizing it. The first step when you're ready to release your funds is to complete a determination online via your MyGov portal. Once you've received your determination, you're able to request a release of your funds. It's important to note that this must be done either before you sign your contract or within 90 days of signing your contract. If you release funds outside of this time window, you will be liable for FHSS tax. If you opt to release your funds before signing a contract, you should be aware that you have 12 months within which to purchase a property. Failing this, you can request an extension of a further 12 months for a total allowable time period of 24 months. Upon purchasing your property, you should inform the ATO so that they're aware that you've made the purchase and you're not subject to FHSS tax. Now let's put all of this together in a case study. Consider someone on an income of $100,000 who contributes $15,000 per annum into the FHSS scheme and then purchased a new property valued at $800,000 with the first home deposit guarantee. With the FHSS, after 4 years, they would have saved $48,738 compared to $36,461 if they've just saved utilizing a savings account. That's a benefit of $12,277 in excess. They'll then save $30,529 through their stamp duty exemption. In addition to this, an extra $35,479.91 they'll save through not having to pay LMI, and they'll receive $10,000 as a consequence of the first home buyer's grant. That's $88,285.91 saved through a culmination of all of these schemes. That's a huge saving for this individual in the case study and has really helped them accelerate their property purchasing journey. As always, if you've got any questions or comments or something you'd like to learn, leave it in the comments below and we'll get to it as quickly as we can.